So you probably pay for some kind of insurance, right? Car, home, health, and you might think their business model is pretty simple. They just need to collect more money in premiums than they pay out in claims. But what if I told you that's not really how they make the big bucks? Turns out, the insurance industry has this sort of hidden financial engine, and today we're going to pop the hood and see exactly how it works. And that's a really good question, isn't it? I mean, think about it. These companies cover everything from a little fender bender all the way up to monster hurricanes that can wipe out entire towns. So how on earth do they stay so consistently profitable when they're facing such massive, unpredictable risks? The answer isn't just about being good at math. It's about a really powerful financial concept that turns the premiums we all pay into a giant money-making machine. Okay, so here's the breakdown. On the left, you've got the simple view most of us have. The money they bring in from premiums minus what they pay out in claims equals their profit. Yeah, that's what's known as underwriting profit. But honestly, that's just one piece of the puzzle. The real secret sauce is on the right, the investment profit. This second engine completely changes the game, and it's where the truly mind-boggling returns are made. So where does all that massive investment profit come from? Well, it all boils down to one key concept, the industry's not-so-secret weapon, something they call insurance float. So what is this float thing anyway? Think of it like this. It's the giant pile of our premium money that an insurance company gets to hold on to after we've paid them, but before they have to pay out any claims. Now that time gap, which could be just a few months or it could be years, even decades, is incredibly valuable. Because during that time, all that cash isn't just sitting there, it's being invested for their benefit. It's their money-making machine, and it's powered by our money. You know, there's one person who absolutely mastered this, and that's Warren Buffett. He put it perfectly. He called float money that doesn't belong to us, but that we can invest for Berkshire's benefit. He basically built the entire Berkshire Hathaway empire by perfecting the art of using this float. It's the ultimate financial hack. It's like getting a massive, interest-free loan that you can then use to go out and make even more money. Okay, so how much money are we actually talking about here? And what in the world are they doing with it all? Well, let me tell you, the scale is it's hard to even wrap your head around. Get this. By the end of 2022, U.S. insurers were sitting on $8.2 trillion in cash and invested assets. That's trillion with a T. That's the float, a massive war chest of capital that they get to put to work in the financial markets every single day. And look, this isn't something that just happened overnight. This chart really tells the story. You can see this pool of money has been growing steadily year after year. Over just the 10-year period you see here, their total assets grew by almost 50%. It just shows you how consistent and powerful this whole float-generating engine really is. So what do you even do with $8.2 trillion? Well, as you can see, the strategy is all about playing it safe, mostly. The huge chunk, over 62%, that's in bonds. They provide that stable, predictable income you need to pay claims down the road. But they don't stop there. To juice the returns, they layer in common stocks, mortgages, and a mix of other assets. It's this carefully balanced portfolio that's designed for both security and profit. But here's a really key detail. Not all float is created equal. The investment strategy totally changes depending on the kind of insurance. Think about your car insurance, right? If you have a fender bender, that claim gets paid out pretty fast. That's called short tail insurance, and the float from it has to be invested pretty conservatively. But then you have long tail insurance, like certain kinds of liability policies, where it could be decades before a claim gets paid. That gives you insurer a much longer time horizon to invest in things that could have a way higher return. Okay, so we've got this whole playbook down, right? Premiums come in, float gets invested. But here's the thing, that playbook is getting a massive rewrite as we speak. There's been a fundamental shift in the economy, and it's changing the rules of the game for the entire industry. You have to understand, for something like 40 years, insurers operated in a world where interest rates were almost constantly falling. That made it tougher and tougher to get a good return on those giant bond portfolios. Well, that era is over. Done. We are officially in a brand new world of higher interest rates. And these new, higher rates, they're a classic double-edged sword for insurers. The good news is pretty obvious. All the new cash coming in can now be invested at much better yields, which is great for future profits. But the bad news is that the market value of all the old, low-yield bonds they already own has tanked. These are called unrealized losses. Now, it's not a real cash loss unless they're forced to sell, but it sure looks bad on the balance sheet. So this isn't just about numbers on a spreadsheet. This new environment is attracting a whole new set of players to the game. New money is pouring in, and of course, regulators are scrambling to keep up. It's really setting the stage for what the future of this industry is going to look like.
There are really two huge trends you need to be watching here. First, Wall Street wants a piece of the action. Big private equity firms are buying up insurance companies specifically to get their hands on that float. They see it as permanent capital, a steady, reliable mountain of cash they can use for their own, often riskier investments. And second, the regulators are responding. They're getting a little nervous that these new owners might be pushing insurers into riskier, more complicated investments. So they're working on new rules set to kick in around 2026 that could force these firms to hold more capital just in case, which could really change the math for everyone.
So what we're seeing here is this massive convergence, right? Wall Street's relentless search for capital is crashing right into the insurance industry's giant float. And it leaves us with a really important question. In this new game, as these two worlds merge, who ultimately stands to win the most? Is it the investment firms, the shareholders, or is it us, the policyholders, who are counting on these companies to be there for us when things go wrong?
This is not financial advice.